Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. We're covering earnings reports this week. In this video, we have our senior equity analyst, Ben Nye, discussing Citigroup. Thanks for joining us.
Okay, well today we're going to be talking about a variety of earnings reports. Citi is coming out of the woodwork like Wells Fargo's in right now. Citigroup has had a rough time of it. They're most international of the big banks, huge India business, big Latin America business in Mexico, really reasonably large European business. So they're just much more global. And it's tougher to manage a huge aircraft carrier than it is a battleship. And so that's what Citigroup is going through and has been going through. And the problem is in the crisis, they really took a hit. Citigroup really took a hit. They had this bad bank and they ultimately ring-fenced that, called Citi Holdings. They've now reincorporated it into the actual results. And they're actually doing relatively well now. Their quarter itself wasn't incredibly strong. Although they beat on a number of levels, it just wasn't the blowout that JP Morgan had. Their EPS was $1.68. Street had them at $1.61. Their revenue was right in line with expectations at $18.9 billion. On the negative side, they didn't achieve, we were talking about Wells Fargo, they didn't move down on that efficiency curve as much as the street had wanted. Bear in mind that these guys want to get into the low 50s by 2020 on the efficiency ratio. Last quarter in Q1, they only were at 57.9. They were down 50 basis points on a quarter-over-quarter basis. That's not going to get it done. You got 8 quarters to turn this ship around, and if you're going down 50 basis points each time, you're going to be maybe in the 54, 55 range. Low 50s should be 52. So Citigroup is battling that. Analysts were not happy with how well they did that. There was weakness in mortgage. And this is something actually Wells Fargo touched on as well. There's a little bit deceleration in mortgage. On Wells Fargo, you had a compression on gain on sale margins. So you originate a loan, you sell that loan through a mortgage-backed security, or you just sell it to another bank, and you make a margin on that. And it's usually pretty thin, but it's good money, and they're very volatile margins. Sometimes they're as high as 1.5%, even 2%. For Wells Fargo, they were 94 basis points, 0.94%. And Citigroup suffered from the slower housing market as well as the higher funding costs. Importantly, when you're thinking about Citigroup, people like to look at the net interest margin. Again, how much are you making on your loans versus how much does it cost for you to get capital? And Citigroup has actually only assumed one Federal Reserve rate hike for 2018. They assumed that was going to happen in June. Every rate hike after that adds $80 million a quarter. So we got another rate hike in March. They still think they're going to get another rate hike in June, but we got the one in March, so that's going to add $240 million in net interest margin over the course of the year. And like JP Morgan, they're not seeing much pressure on the deposit side. So those margins are increasing. Furthermore, they have much more sensitivity to the short end of the interest rate curve versus the long end. And this means that even if the 30-year bond goes down and the 10-year bond goes down, what you're going to have is if the Federal Reserve continues to hike rates, you're still going to have that net interest margin to perform well. So that's good news for Citigroup, but again, bad news on the efficiency ratio. I believe it's relatively explained. They're making investments right now, and those investments should begin to mature in the second half of 2018. So you're going to have slower spending in the second half, and then you're going to have the productivity benefits as well. So on the spending side, you're improving, and on the productivity side, you're improving. So it's almost a twofold benefit, which makes it also a little bit concerning because you'd rather have a bird in the hand than one in the nest, as they say. And right now, there's a lot more to come from the second half, and a lot of analysts just say, with the difference in performance between something like Citigroup and something like JP Morgan, just go with the better operator. With Citigroup, though, you're operating at a much lower valuation just versus a tangible book value basis. So you're buying a worse company at a cheaper price. So do the math on that. I think that ultimately comes down to personal preference. On the card business, Citigroup has really grown cards pretty well. That should begin to taper off. They've had to spend a lot of money on promotions, but that should be able to stabilize here in the next year or go. There will be some attrition. They think there'll probably be about 50% attrition on that card business, but with the promotional balances. But they expect that to right now it's behaving in line with their model, so I'm not too concerned about that.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.